This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 94. Is a trade deficit a bad thing?
Welcome to the Debunking Economics Podcast with Professor Steve Keen. I'm Phil Dobbie, and today, the problem with a trade deficit. Well, what's wrong with a trade deficit? Donald Trump seems to hate them, but if you're importing lots of goods, doesn't that mean you're generating money in your own economy and people are wealthy enough to buy those goods? Is that really such a big problem? That's today on the Debunking Economics Podcast. Well, Alex Howlett, one of Steve's supporters on Patreon, wrote in a comment recently that he doesn't see a problem with a trade deficit if a country can produce its own money, because if you have a deficit, then other countries are happy to take your money as a payment. So it must be worth something. You just keep on printing it to buy more goods. Whereas if you have a trade surplus, countries aren't as willing to sell their goods to you as cheaply, so you have to produce more money to buy it, which creates inflation. And to avoid inflation, you have to produce more of your own stuff in your own country. So he says our country can still continue to print money so long as the additional spending is activating unused productive capacity on your own economy. Otherwise, we get inflation or measures that are introduced to inhibit inflation, which obviously can only be a bad thing. So in short, he's saying it's better to be in deficit and print money for overseas than it is to develop money for domestic consumption. So in other words, Steve, he's saying a trade deficit is a good thing, not a bad thing.
Yeah, well, this is one point I've had as a point of dispute with modern monetary theory for a long time, and it comes out of, and as I put this to Alex, that this is a very United States-centric view, because it's very easy for the United States to give pieces of paper in one direction and get goods in the other, but it's not so easy for, let alone Australia. It's any country that is not, whose currency is not accepted in international trade, can't do that. They've got to actually buy another country's currency, to wit the United States, before they can actually buy those goods. So I think this is something which comes out of the United States having a very unique position as being the reserve currency of the planet, and therefore any other country can run out of United States dollars except the United States. And what has come out of this, I think, is a contradiction of the basic logic of modern monetary theory, because what modern monetary theory starts from is saying, let's get your accounting right. And what is actually happening when you're running government deficit? Well, what you're doing is you're actually crediting bank accounts of the private sector. Whereas if you run a government surplus, you're debiting the accounts of the private sector. So in one case, you're creating money, in the other case, you're destroying it. And therefore, government deficits are a good thing to the extent to which they provide the money that the private sector needs for its own commercial activities. If you go in the other direction, then it's bad. So that's, I entirely agree with that. But I think when it comes to trade deficits, the logic's been screwed up, because being American-centric, and Warren's having a fairly, he's a good guy, but he's got a very forceful personality, and he also was funding a lot of the research being done by people in modern monetary theory. So I think there was an unwillingness to actually take him on this front. As somebody funded by my patrons, I'm not worried about taking anybody on, even including my patrons. Here, g'day, Alex. Hope you're enjoying the conversation, because it is inverting the accounting understanding that vision, the modern monetary vision, gives of both about the behaviour of private banks and the behaviour of the government sector. Because in both cases, the modern monetary theory is playing quite, in accounting sense, quite correctly. You will create money if banks lend out more than they get back in repayments. You will create money if the government spends more than it gets back in taxation. And then they stuff up on a foreign trade, because if you think about the logic the same way, you will create money if your current account inflows, in other words, the money you get from the rest of the world for selling goods and services. But let's leave it at the goods and services stage. It gets confusing, including financial assets there. Working strictly in terms of a trade balance. If you were selling more goods to the rest of the world than you're importing back in your domestic currency terms, then you are creating money through that process. So let's take a single transaction. Let's imagine that a Australian company, let's say it's actually a German company is selling Mercedes-Benzes to a UK buyer. Then the UK buyer goes to the shop where the Mercedes-Benz is and hands over, let's say £100,000, that £100,000 has to be shipped to the German manufacturer. If the money goes directly to the German manufacturer Mercedes takes £100,000 to the Bundesbank, deposit the £100,000 in the Bundesbank. The Bundesbank then does the exchange rate conversion. Let's say, well, that's worth 110,000 euro. So we put 110,000 euro into the bank account of Mercedes-Benz. You have created 110,000 euro. So the role of an export surplus is another way that you can create money domestically. Now, the reason I think that the modern monetary theory has gone, in my opinion, wrong on this point is that the same process does not apply to the rest of the world. It does apply to the United States, and that is that if you want to buy goods from overseas, at the moment, you've got to convert everything into American dollars. Now, if you look at the case of, let's say a British company trying to buy Mercedes-Benz, well, the Mercedes-Benz, that's a straight pound to euro conversion, but imagine you've got to go through American dollars to do it. Then you've got to first of all sell those pounds, buy American dollars, and then use those American dollars to purchase the German goods with euro by doing the American dollar euro conversion, and that is something which takes you into the international money market. You're selling pounds to buy dollars. You're driving up the price of dollars. It all benefits the American economy that way. It makes the American currency more expensive than it would be if it wasn't the reserve currency. Now, what this means, if America keeps on doing that, first of all, because the currency is overvalued, because it being a reserve currency, it's being bought for not just for goods and services, but also so that other countries can trade. You've therefore got a higher price in America. American goods are more expensive internationally. That's partly where the trade deficit comes from.
Yeah.
But they can keep on doing it because people continue accepting American dollars. Now,
but
in the rest of the world,
if you didn't go through the American dollars in that process, then in the example that you gave, if people kept on putting a demand on, for example, buying something that was in British pounds, then that would increase demand for the British pound. So the British pound would be worth less because everyone wanted some. Yeah. And this is the other story, because what you start doing is when you think about when the money gets, let's go to the Mercedes-Benz example again. If you bought that Mercedes-Benz car, you've created money for Mercedes-Benz out of the transaction, which you can use to invest and produce better Mercedes-Benzes. Now, if that continues happening for long enough, your Vauxhalls and your Leylands and your what's the other company, Jaguar, all become owned by foreign companies. And gee whiz, I think that's actually happened, hasn't it? Yeah. So they'll shut down. So what you get is that you deindustrialize your country in the process of running this trade deficit. And that, to me, is the problem. This is partly with modern monetary theory. It's very, very good on understanding the monetary dynamics and the accounting and the role of government and so on. But you have to link it with what happens to the productive economy as well. And in this particular case, I think quite sensibly, modern monetary theory says running an export surplus is a better way of creating money for yourself than is having government money creation or having banks creating more loans than they get back in repayments, because it's actually building up your productive resources at the same time, and it outsources the cost of you doing the manufacturing to some other country. So all this stuff, and you look at the successful countries around the world, leaving the United States out of it for the moment because it has that stupid advantage. It's an unfair disadvantage of being the reserve currency. The countries that are the most robust on the planet, apart from those that have got themselves into financial crises like Japan, they're ones running trade surpluses. Germany, China, South Korea, all these countries are running huge trade surpluses. And in Germany's case, the trade surplus is so big, it's running at about 10% of German GDP, that both government debt and private debt is being reduced because the amount of money being created by exports being in excess of imports is so great that Germany, money creation by that route alone means you can have money destruction by the other two routes while still having an increasing money supply. So isn't the textbook theory, and I know you hate it when I use that term, textbook, because they're invariably wrong. But I mean, if we put aside the fact that the US dollar is used as a reserve currency, if that wasn't the case, I mean, isn't the idea that say take the UK for example, if we had a trade surplus, then there's going to be demand for the pound, so the value of the pound is going to rise because there's demand for it, which is going to make our exports more expensive. So in theory, that would reduce our exports. It would increase the opportunity for somebody else, but then the same thing would happen with them, and then the system should balance itself out. That's the idea behind floating exchange rates, which hasn't happened because, again, partly several reasons for that. One is a huge part of the transactions are financial transactions rather than driven by goods and services. The ratio is of the order of 100 or even 1,000 to 1. So financial fluctuations and speculation far and away plays a bigger role than the actual trade situation does. So that's a major problem in them equilibrating. I think that in terms of exchange rates leading back to an equilibrium situation, sort of a tendency to restore all current account surpluses to zero. But the other side of it is that even if you actually had a world where it just was just driven by trading and the financial sector was just facilitating rather than dominating with speculation, in that situation, in a dynamic process, it's possible that the rate of increase in money supply and investment that enables in the fact of running a trade surplus would be enough that you can continue innovating and pushing your technology ahead of other competitors' technology. So because you're producing better and better cars every year, you continue getting a exchange rate surplus, a current account surplus, even though your currency is appreciating. I'm looking at you, Japan, because that's exactly what happened in Japan. I think from memory, the first valuation of the yen to the American dollar was 360 to 1, and it has something to do with some historical. I forgot what is some historical coincidence. That level of the ratio, maybe 350 to 1. Over time, it headed down towards 100 to 1. But over that whole period as well, most of the time, Japan was running a trade surplus. And what it's saying, in other words, that the process of investing and innovating and the virtuous cycle that comes out of running a trade surplus, which finances part of the innovation you're doing, happens faster than the currency actually adjusts. And so you can have a permanent trade surplus. Now, you add to that the situation like the euro, which is locking the high inflation countries of Europe into the same currency as low inflation Germany. That gives them Germany an inflation-driven advantage in foreign trade within the euro region and globally as well, because the euro would be worth, if the mark existed, it'd be worth more than the euro. Yeah. That gives Germany another advantage as well. And then you have active policies on top of that. So it's a system where you simply forget about exchange rate changes driving you back to zero again. It won't happen. So, and this is one of the major reasons that Keynes wanted to have the Bancor. Yeah. The idea of the Bancor was to have an international currency not owned by any particular country, fixed exchange rates between each current national currency and the Bancor, and you could run out of Bancor by running a trade deficit. Now, if you did run out of Bancor by running a trade deficit, you would be forced to go and ask the IMF to let you devalue your currency. But that would be balanced on the other side by countries running surpluses would be forced to appreciate their currency, or they would be taxed by the IMF on part of that surplus, and that would be redistributed back to the deficit countries. So Keynes's idea is very, very different to this notion that modern monetary theory has got about trade deficits being a good thing. In fact, he saw them as the biggest danger for stability of capitalism over time, and he saw the tendency that deficit countries having to impose deflationary policies on themselves, where surplus countries not being required to run stimulatory policies, it gave you a deflationary bias to global finances. So that's why you want to have the Bancor. So let's look at that. So let's look at the problems of a deficit then, because you're mentioning the inflation, which is obviously one of the causes of it. I mean, your currency, and if I'm right, basically you've got a deficit, so there's less demand for your currency, so your currency starts to lose value. If your currency starts to lose value, then you start to see inflation pick up. But you've also mentioned this as well as another disadvantage. If your currency devalues, then everyone starts buying up your companies.
Yeah, and you start losing your asset base. And I think a large part of what this is something America is not immune to. And this, of course, is something that Trump has latched onto and very, very heavily, is that if you're running a permanent trade deficit, and you're not reinvesting as much as you would be if you're running a trade surplus. Your companies fall behind the other companies, and of course, of companies from other countries. And of course, America's made this even worse because they've quite actively been involved in relocating production offshore, and particularly to China. And of course, Elon Musk was actually out recently tweeting, being outraged that you couldn't, if you invested in American company invested in China, it can't have any more than 50% of the business. Whereas in America, if a Chinese company invests in America or a German or whatever, they can own 100% of the business. And he was outraged by this. In fact, that was a very clever part of China's own policies. They wanted to secure a trade surplus, and they wanted to get as much American technology as possible. But they knew that if they just went for the cheap labor jobs, then no profit would be kept back in the Chinese economy necessarily. No control would exist in the Chinese economy. And you would have, when the wages rose, at some stage the Americans would move on against some other country, as they had done throughout Southeast Asia before China joined the free trade zone game. So they said, and I met the people who designed the policy in 1981-82. I'm talking about conversations I had back then with the people who built the Shenzhen Free Trade Zone in China. And they said that the purpose was they were going to take advantage of a loophole in the American, a legitimate loophole, one that the government itself allowed, in the American import tariff laws that enabled a company to export unfinished goods, partly finished goods, to a third world country, work on them in the third world country, and re-import them back to America without paying any tariff on the increase in value. Now, that was done there as part of an overseas aid idea, as part of the trade policy. And the Chinese saw that we can offer that, but we'll do it with a little condition. Yes, you can take advantage of our wages being, 1/30th what they are in America, which is pretty much the ratio that applied in 81-82. You paid a Chinese worker for a month what you paid an American worker for a day. So we offer this huge carrot to American corporations, but we attach the condition that to do it, you must have a Chinese partner, and within 5 years, the Chinese partner has to own 50% of the business.
Yeah.
Now, that gives you an idea of just how attractive this deal was to American corporations, that they had to give up half the ownership over a 5-year period. It was still worth their while to do it because they were paying so much less for the workers. And gee, hasn't that worked out well in the long run for the workers? Well, what it's meant is that rather than building manufacturing capability in America over time, the corporations were involved in this whole process of basically asset stripping America. That's where the Rust Belt came from. So I don't think it's been at all a good idea. I think it's been, and this is because of what Trump has now done with his tariff appeal on steel, is say we're going to rebuild the Rust Belt.
Well, this is China's way, obviously, of getting some foreign direct investment without losing control and still managing to ensure that they're taking a big slug of the profits. Oh, well, we're talking about China. I mean, the Chinese currency doesn't float freely, does it? It's pegged to the US dollar. So presumably that keeps it, if China has this big trade surplus, then that is artificially holding the one down, isn't it? Because if there's and it would be much higher if there was high demand for their exports. As we're talking about trying to reach this balance, China's not playing ball with that.
Yeah, and that's again a common, if you're in running a trade surplus, you can get away with that game. You can continue. When you get these, you're getting an export. You're getting money coming up, which is turned into renminbi. They're getting into yuan or your local currency. But rather than letting it get into your domestic economy, you then use that money to buy American assets. So you offset the lower demand for American dollars by buying American dollars, and you therefore stop your currency falling. So you maintain that advantage indefinitely. And trade surplus countries can do that because they've got an indefinite supply in that sense through the trade surplus of American dollars. Whereas those running a trade surplus country can do it. Trade deficit countries can't do that. So again, it's something which biases things in favour of countries running trade surpluses. And back to Keynes's point, that forces deflationary policies on countries that are not running trade surpluses. And by definition, that's an equal amount of money to the trade surpluses themselves. So you have a deflationary tendency coming out of this in the global economy.
So how much of all of this is being influenced now by this shift that we're seeing from manufacturing to services? The fact that countries like the UK and the US don't make a lot, they don't physically make a lot, they have to import the stuff that they're consuming, but they have a strong services industry.
Yeah, well, I'm afraid this is one of my favorite lines, and that is that people talk about a post-industrial society, and I agree. There is such a thing as a post-industrial society. It's called hunting and gathering.
That's what we're going back to.
Yeah, if you keep it up for long enough, you deindustrialize so much that all you can do is live off the land. And I'm giving exaggerated case there, of course, but if you look at what's happened to the Rust Belt in America, that's pretty much what's happened. The productive capacity is gone. It hasn't been replaced by anything else. There are only service jobs, which by definition you can't have competition in haircuts around the world. So you get low, or you can't have competition in security. Security guards walking around either. You get low-paid jobs like that taking the place of what once were high-paid jobs in manufacturing. And you also, when you look at what are services, the vast majority of so-called services are what's been done by finance, insurance, and real estate. It's the aptly named fire sector of the economy, and they make money by putting the rest of us in debt. So particularly in the UK, a huge part of so-called services is selling debt. Now, that's not exactly a good thing in its own right. And of course, after a financial crisis, the business suddenly evaporates. So in the UK's case, they thought they could actually, and this is one of Maggie Thatcher's myths, she thought that they, by deregulating, as well as thinking that would liberate and make much more innovative British industry, she also thought that they'd have a services sector surplus, making up for any trade deficit on manufacturing that occurred. That hasn't been the case. What you've had is the deficits continued growing.
Well,
I don't know it precisely, but it's certainly more than 3% of GDP. So services have not made up for the fall in manufacturing exports.
Right, but I mean, services are still sold for a price. Like I export services to Australia, for example. I sell a service to an Australian bank. They pay me, and I import that money in. So that's helping the UK balance of trade, and not significantly, of course. I don't charge them that much, but it's helping the UK balance of trade.
To some extent, that is.
It was really different from me selling them.
It's just not
selling them furniture.
This comes back to the energy point beforehand that we had talked about as well. The genuine physical surplus in production occurs in manufacturing, because that's where you're harnessing free energy to actually make into useful work and goods and services and so on.
You're saying what I'm saying is not. You're telling me what I'm doing is not useful, Steve Keen. Is that what you're saying?
Yeah,
but why would it be?
I wouldn't be invited to your birthday party, so I can't say that.
Why would selling a service that somebody is paying for be any different to selling a piece of furniture that somebody's paying for?
Because productivity doesn't rise over time. You can't produce. You're not going to be doing twice as many podcasts next week or the next year, and twice as many the year after, et cetera, et cetera. I'm not talking a 100% rate of growth in manufacturing either. But manufacturing productivity rises because over time we work out how to harness more energy, and we consequently get things done with a greater amount of energy content.
Right. So it's the scalability. So it's the scalability of services, which is the
scalability. Save services don't scale. Right. So you're not going to produce, like, if we imagine going forward, let's say there's 3% growth in labour productivity in manufacturing over a century, then every 20 or so years you double the amount you're producing per worker. So if you double, you're talking about 32 times as much output. No. I don't think Phil Dobbie, had he lived for another 100 years, we're producing 32 times as many podcasts.
Well, look, if I live for another 100 years,
growth just isn't there.
Yeah. All right. Okay. So finally, when economists say, well, look at this, imports are up and exports are up, but not quite as much. So our balance of trade has fallen. But look at this, isn't it a great sign? Imports are up. That means we're seeing growth in the economy. People are buying. Retail's looking strong.
Well, the imports actually turned up as a negative for GDP. This is actually a very good point made by Vox Day recently when he had to substitute for me on a radio show. He said that if you look at the case of with Trump's objective of reducing imports and increasing exports, if you take the extreme example of, let's say we could just go to complete autarky overnight, eliminate exports and imports, ignoring feedback effects, which you have to do in this sort of hypothetical, then that would increase America's GDP by 3%, because the gap between exports and imports is about 3% of GDP.
No.
So in that sense, you'd actually increase GDP by eliminating imports and exports. Now, that's a hypothetical, it's a thought experiment, but it does make the point that part of the way we actually define GDP includes seeing imports as a negative. Now, that's why I have a hard time, one of the reasons I have a hard time swallowing the MMT argument that it's a positive. And I think it's because, again, as I said at the beginning of this whole segment, you've got to think through the logic completely. And the same logic that applies to government money creation and to private bank creation also applies to creating money through international trade.
So if the US keeps growing somehow for by whatever mechanism, and it keeps demanding imports as it has been, but and there's enough domestic jobs keeping people employed and perhaps getting richer so they can keep on importing, that just can't go on forever, even though it's gone on for quite a long time already.
Yeah, that might sound good because you do deindustrialization keeps on going, and at some point, you're going to have to be outsourcing your nuclear arsenal to foreign companies. Let's say, for example, Russia.
Yeah.
You're not going to be taking all that seriously anymore.
So those domestic jobs aren't going to be there, basically, to give people the money so that they can import. And yet they are so far. I mean, America, I mean, if you believe the statistics, and I know you don't entirely, but they're saying, jobs have never been better.
Yeah, well, they've had a that's another thing for a future conversation, but a QE-led recovery leading finally to credit growth once more, and the economy is relatively booming, but still below the level of productive capacity.
So it's debt. It's debt funding those jobs.
Another story. Yeah.
Okay, very good. All right, makes a lot of sense. Great to talk again, as always, Steve, and we will perhaps pick up on that subject next time. Thanks for coming on.
Okay, and thank you, Alex. I look forward to your further feedback on the discussion.
Yeah, let's hope he hasn't cancelled his subscription as a result of it. So look, that came in as a response to a comment that was left on the Patreon website. If there's something you'd like us to discuss, then you can do the same. Leave a comment or send an email via the site, or you can email me as well, phil@loudmouthcoms.com. And next time, I'd like to discuss the importance of land values on the economy. It's a scarce resource. We've got a growing population with an expectation of increased living standards. How can that possibly work? That is next time on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Thanks for listening today.